Welcome to the Trading Pit, virtual gathering for sophisticated traders. It's January 30th. On today's amazing show, I'm asking, will we see Bitcoin in the 30K again? Is the best trade since 2020 approaching us? And what do ETF flows mean for this Bitcoin and crypto markets? Trouble or smooth sailing? I want to know. This is Marconi Wine. Today, I'm joined by two of my favorite analysts, 90 Music's nostalgia, JJ the janitor, and Ben, I always want to talk rates. Lily, gentlemen, welcome. We're going to dive into the analysis with JJ, but first, I want to give a special shout out to CoinCall, who has offered to sponsor this video. For those new to CoinCall, they offer a full suite of options, futures, and spot trading for your favorite crypto assets with competitive fees. And of course, that elegant interface that everybody needs. No one wants to be trading on some rank interface. They offer the best. Go check them out. And if you don't believe us, JJ, who's stuck on Joker right now, is going to show us what their interface looks like as he goes over his DGen trade of the week, which has been doing quite well. So you're not going to want to miss that. So definitely stick around. All right, JJ. You know, last time we were on the show, last Thursday, we were sitting there in the 38K range. Now Bitcoin's back up above 40K. Tell me, what's the mood of the market?
Good morning. Good morning. So, yeah, like we said last week, really found support there at the 100-day moving average. We could see here, got a nice clean bounce. We said that it was probably
you're jumping ahead. You're jumping ahead. Is it the bulls, is it the bears, or is it something in between?
It's indecision right now. Like, as we were saying, there was just way too many shorts hopping in there at the lows, and that's typically a story that doesn't end too well. You short into the hole, it bounces back. So we're trying to find footing, repair some technicals into the end of month.
For all those, I got to jump in here. For all those who want to know, JJ, as soon as you get in and start getting him going, he's just wound up machine, and we'll just keep on charging forward with all the information. So
sometimes I have to single chart for an hour if you wanted me to. But
all right. Okay.
It's never a binary thing, right? Like
it's never a binary thing. All right. Well,
sometimes it is. Right now, it's not. Like we're trying to figure out what the hell is going on exactly here into the monthly close.
All right. Well, we're sitting in indecision. Walk us through what does spot look like?
All right. So what we saw here, it came down, tested the 100-day moving average basically perfectly last week. Then we saw kind of an influx of short interest. Things just the sentiment was entirely misbalanced. So you basically had Reddit channels that were tracking the GBTC outflows and whatnot. The fear was outweighing the actual amount of selling that was coming into the market at a certain point there. It just got overdone. People started selling into a brick wall temporarily, and then we got this mean reversion bounce. And now here we are in the monthly close, and we're trying to see if they'll close this monthly bullish, if they keep it above, say, the 50-day moving average. Monthly close or monthly open was around 42,400, I believe. So January 1st, that was the opening price. So if they can kind of if they can resuscitate this candle, get a green candle and some momentum into the end of month, it should be bullish for approximately like the first week or two there in February. We could regain some momentum. We actually see this here on the daily, right? So this 50 RSI mark we pointed out a couple weeks ago, we lost it the week of the ETF, and we just regained it right here on Saturday. So we popped back above it, and as you see, that's the first time that we've regained this 50 moving average after losing it since October, and we can see the momentum that followed there as well, right? So they're trying hard to paint this chart bullish. The issue that I see right now is it was driven by a lot of short liquidations. So there was a whole lot of people that were off sides, short in the hole. Like we said, that sentiment just got overdone. People were expecting lower right away, and markets don't move that way. Typically goes in a choppy fashion, right? So as we can see here, these green lines indicate large amounts of liquidity pools that were tapped to the upside. So we had a pretty substantial squeeze here in the past couple of days. We're going to need to see some continued momentum from buyers here. So they're in control, but they have to take the ball and run with it into the end of the month.
I am going to be asking on the spot side if we're seeing some volumes there, but I guess this looks, what we've been talking about, I guess, for over a week now is sort of, are the bears really in charge? Is it more just a consolidation period?
It's hard to say, right? We'll know within a couple of days. If we look at the spot order book here on Coinbase, we see that it basically looks reversed now to the way it looked on the way down. So the way down, we had large bid walls underneath, and then they were basically using these bid walls to sell out of positions at the current price. You could see that in the red candles. This would be a time-weighted average price out. So they were keeping price elevated by using these bid walls, and then they were selling into it. And basically yesterday, we saw the opposite in where it looked like they were swapping into positions, so buying it and using ask walls to keep price suppressed. So as they were filling these orders, these basically kept price in range, make sure it didn't jump up above like 44,000 in a single day and get too overheated. So this is kind of a healthy, especially if we see it continue, like they continue to move these ask walls up without them getting filled, and price just continues to climb while we see it swap in. That's a pretty bullish thing. Yesterday, the Coinbase premium returned, which is basically showing you that people are paying a premium to buy spot on Coinbase as opposed to Perps or Binance or the offshore exchanges. That's another bullish signal. It obviously shows that ETF inflows are a real thing, and it's driving the market substantially here. So after the amount of selling that we did absorb over the past couple of weeks, if there is a time to accelerate back to new highs, it would seem to me that it's going to happen within the next couple of weeks here.
So tell me, I mean, on the last couple of shows, I think we've sounded extremely bearish, talking about the fact that we had lost momentum. Has everything just changed in a week? Was some of this just camouflage, maybe in the data? Or perhaps there's something else going on? We have a news event. Obviously, this is the FOMC this week. We talked last Thursday about this potential liquidity Armageddon event that's going to happen down the pipeline with the Fed changing and the Treasury changing a series of policies. I'm going to let Ben kind of speak to that in a moment. But what's your sense here of what we're seeing in the market? Is it true new buyers, or is it ETF action? Or is this just, I guess, a delay before we see this capitulation wick that we've been talking about as well?
Not much has changed in terms of the long-term picture in my mind. So you kind of have to balance the two opposing views in your mind at all times. So you have kind of your short 1 to 3 week time frames. And right now it seems like there's some bullish momentum there. But ultimately, by the end of quarter one, I'm still expecting at least a 200-day moving average retest. But that doesn't mean we can't go to $52,000 first, right? We could go much higher in the short term than you expect. So you don't want to be married to that longer term bias. But have it in your mind if things start to break down, right? So if we start to return to the lows, then I think that's really when you want to keep that liquidity crisis event in your mind. But as long as price is moving up, you just follow it level to level, right? So I'm balancing those two views in my mind. I think that we probably get higher here into the end of the month, early February, especially if they close the monthly green. So close above, say, this 50-day moving average would be extremely bullish into the end of January, early February. And that could give us the kind of momentum we need to take out the highs, tap the liquidity above 50K, and then probably sometime in March, we see it fade back down. But you don't want to be so married to your longer term bias that it obscures your view in the short term, if that makes sense.
Yeah. Ben, I want to bring you in here. What's your perspective on the pre-market action that the JJ just shared?
Yeah, good morning. It's pretty similar in terms of patience. I think that's the way that we could almost sum it up. We painted a pretty bearish picture last week, and I don't think anything really has changed there. The hard part, though, is whenever anybody's mind starts to get made up that things are turning bearish, it's almost like an immediate reaction to go ahead and basically respond or act on that new thesis that was formed, when in reality, this is multi-month type of thinking here, where it's more of like a subtle short-term regime change in the order of 2 to 3, really up into the halving, is the time frame I have in mind. So at the moment, now is not necessarily the time to really jump into any new positions because we're going to see big moves higher. It's more of just seeing a confirmation show up in the charts that this short-term regime change over the next 3 months is beginning. And that's kind of what I'm looking at. I wrote about it in Espresso, I guess, this morning. And right now, I wanted to watch the open to see if price taps the liquidity that's sitting just above 44,000. If it does it, and you see some bearishness get painted today on the charts, that's essentially confirmation to me that the market is not as strong as it could be, especially during the New York session, where these ETF flows are really dictating things at the moment. And so it's more of, like I said, patience, but knowing when you're getting the confirmation painted on the chart and then acting accordingly, not just jumping in and getting to it.
Well, I think patience is the right word. I'm looking at the chat here. We got Ollie Kuhlberg. He says, I was hoping for 36K, but now RSI is at 50 and we could just chop. I don't know. So is it possible his patience will be rewarded and he could see that 36K again? And it just may just take a couple of months?
I mean, if you look at, let me pull this chart up because I think JJ's got a similar chart up on his screen. Actually, the chart that you got up right now, that was kind of what JJ was alluding to. That you can see that the red shaded area at the bottom, that's a bunch of shorts jumping in as price dipped below 40K. And the market's not going to be that willing to essentially allow everybody to jump in late. And nobody rides for free. Yeah, no, we gotta make everybody essentially wait in line, take your turn, and then if you're impatient, you're gonna get burned. So when I pull up this chart, to me, just the price of Bitcoin right here, I mean, you can kind of see that you have a bit of a range forming, and you had that liquidity sweep higher up in this region, and then you had the liquidity sweep lower. So what are we going to do now? And that's really what should be on your radar, right? We had it range bound. We had the sweeps. Now, are we going to continue on sideways for a little bit, let liquidity build? Are we going to go ahead and engineer some? That's what I'm looking out for.
That's a good term too, engineering. So you see kind of these moves that they make. They know the way they're painting the charts, right? Like they know the critical levels the same way we do. We don't have that much alpha. They know just as much as we do. So when you see these moves above the 50-day moving average, that's kind of a move to draw in liquidity or buyers one way or the other above the 50 RSI mark, etc. Like these charts are made to engineer liquidity. So right here, they're waiting for people to take one side or the other and say this is a fake break that's going to break down, or people to bet on it continuing higher. And then whichever side overplays their hand, they'll take the opposite side and sweep their money away. You're playing against very sophisticated actors here, so realize that.
Yeah, ride the wave. Don't get crushed by it. Okay, so what we're saying right now is spot looks like it's gained a little bit of momentum. Perps, got a little bit of reset. Unless you're going to tell me otherwise, and maybe OI's rising. Let's before we start to look at the market open, can you give us a picture about options? I know we talked offline and a little bit on X about this potential short implied volatility. So I want to unpack that, but just are the options markets right now painting a picture at all of where we may be going next?
You still see these implied volatility levels are extremely low. So this has been something that we're pointing out. Like the implied volatility level will stay low so long as Bitcoin's in range. I think its current range is probably about 38,000 last week's lows to probably say 44.5 to 45 or so, right? Somewhere in that range. But if it breaks above it, you're going to see implied volatilities start to rise. You'll start to see there'll be demand for out of the money calls, out of the money puts, etc. But right now, while it's in range, there's a lot of structured products that have come on, which is basically just harvesting yield by selling options. There's a dividend fund that trades as an ETF. They do that. So there's a whole lot of supply of volatility right now and not a whole lot of demand. And what creates demand is ultimately a break of price range. So Bitcoin starts to move outside of its average daily range, and then all of a sudden you'll see demand for volatility. So until that comes on, there really won't be a large spike in options. It seems like some people find value in this level now. Deribit Insights actually had a nice thread this morning. So this shows that there was some demand in the 44K to 45K region or so. These blue lines are basically open options positions, and they're long positions. So these are going to be open calls. So price gets here, we could see a move up as people hedge those sold calls in some way or another, possibly spot buying. That could give us the momentum we need to break above 45K and really get a bullish scenario into early February. But remains to be seen yet. It's not overwhelming volume by any means, or else you would have seen this implied volatility level shoot up pretty strongly, and we haven't seen it yet. So something definitely to keep an eye on. I still think volatility is extremely underpriced relative to Bitcoin's ability to move from this range in either direction. So
Those look like call spreads there.
yeah,
Which, for anybody listening, those are just kind of like bites of the apple of upside, right? It's very limited amount of risk being taken in the market. This isn't when you hear the word gamma getting spewed across crypto Twitter and people think the price is going to go parabolic and everybody's going to be racing to go ahead and hedge themselves. This is, kind of methodical leaps in price.
Yep.
Yeah. And I pulled up a chart to kind of illustrate that point you were making, JJ, on how suppressed volatility is. This is the dark blue line here is what implied volatility was for these various expiration dates at the beginning of the month. So this was just 30 days ago. And this light blue line, right, that's right now. And if you look at, actually, I'll bring it up so the audience can see. This is January 1st up here. Like, we didn't get any sell-off, and usually the sell-off is when people want insurance on their portfolio or their positions. So right here is January the 1st. There's no urgency to scramble and purchase implied volatility, yet it was elevated. And we're coming off essentially a break-in range in implied volatility is down where it's at. That's when we mean that somebody's really selling it and suppressing it. And we just want to see it essentially unwind, because that's going to be when things get incredibly exciting and you'll see the search terms pop back up. You'll see a lot of fear, uncertainty, and all that great stuff.
Well, the market's always exciting when you're along for the ride on XC, right? I mean, it's never boring when you see it our way. Okay,
it's
well,
especially
funny,
when they're
people were
characters.
Yeah. People were so anxious to buy volatility ahead of the spot ETF, but now that and look at the implied volatility levels. So they're paying huge premiums to get long, basically October through January, and then it just fell off a cliff, and now there's no interest. So it's just a funny insight into market psychology. Like, if anything, this should be the level you'd be looking to get long volatility because it's so cheap, but people buy it when it's high, sell it when it's low.
Well, I want to transition, look at some of the pricing now that the market has opened. Now that we've been going over the pre-action, let's actually start to look at some of the action as it starts to unfold. If you haven't already, hit that like and subscribe button if you're out there listening. We love having you along the way. We want you to be able to join every Tuesday and Thursday when we're doing our live show. And as I like to say, if you're bold and you find people that you think would enjoy the sophisticated analysis offered on this show, be sure to share the link. It's easy hitting that share button with the little arrow, and you can put that wherever you want to, be it Discord, Reddit, X, your ex-girlfriend's Twitter handle. I don't know, wherever it makes the most sense. All right, but JJ, walk us through. What are we starting to see as the market opens from a price action perspective? Walk us through some of the charts.
Bitcoin opened at around 43,200. Looks like it's encroaching upon 43,500. So that's a pretty bullish start here. DXY has been sliding to start the open. It opened closer to 103.50. Now it looks like it's moving down a bit. So this looks pretty good for continuation if this continues here today. Thing is that we have the FOMC tomorrow and Thursday. So there's definitely going to be lots of chop. Like, if you nailed this move up, I would probably take some profit here in the next couple hours and probably get a retest of at least the 50-day over the course of the next couple of days if you want to get back in long, even if it moves up to, say, 45. Probably going to come back down and retest this at some point next couple of days. So I don't see a need to FOMO in this range personally. Just watch it, let it unfold. And anytime there's FOMC, it's always whipsaw price action. So would not advise trying to trade through that. You just kind of wait patiently and hope you get some bids or asks filled during those sessions.
Yeah, I wanted to bring that up. You were just talking right before we started to look at the market action about this idea that the market could break either way. And I'm wondering how much of that is going to be an internal impulse, i.e. pressure building up from perps, or is it going to be an external impulse coming in from Dixie, having a large swing up or down based on information coming out of, for example, the FOMC?
I think you'd see a confluence between those two. Like, I don't think they move apart from one another. Like, you see things go very risk on, Dixie drops off, you'd probably see an impulse of spot perp buying, and that could lead us to like a blow off top scenario into early February. Vice versa, you start to see Dixie rip above 104, that risk off sentiment would come back, we'd return to last week's lows. There's a whole lot of room in this range for within range volatility, right? So it's not going to be like a massive spike in implied volatility, but you could see like 42,000 and 44,000 in the same day. So there's large intraday moves, I think, are coming in the next couple of days.
Ben, any insights here from the market open? I know it just happened.
Pulled up DXY, had an interesting move over the last hour on the open. Given FOMC's coming up, it's something to keep an eye on. And then also the 30-year yield, that's getting ready to kind of test its recent lows in terms of the amount it's paying. With the conversation that's really taking place at the Federal Reserve, it seems like they're really happy with all the data coming in. They're happy with GDP. They're happy with labor demand. They're happy with employment figures. They're happy with inflation, right? He even said it recently in the last minutes that the data coming in was essentially a little bit better than anticipated. And where's the incentive for Jerome to cut rates? I don't really see it being there. Right? Like if everything is kind of going as planned, and this is an entity that's not really in the business to front run things and kind of act ahead of time, it's always kind of a lagged entity in terms of how it responds. What will it do? What will it say? I think it starts to reverse a little bit, I would say, in the next couple days here.
JJ, your perspective?
Probably all dependent on what they signal for March. Like I don't think you're going to see rate cuts this week, but if the language is dovish enough, you'll see the market start to front run March cuts, and that could lead us into the blow off top type scenario. If you look at Dixie, like it obviously has had a strong month, but it still is rejecting from this 50 RSI level on the weekly chart. So something to keep an eye on here. If we see a strong reversal, could possibly go back to the lows.
Walk us through what that might look like, because I feel like a lot of our conversations, this feels like this is really keeping the lid on Bitcoin. I mean, if we see a Dixie retreat to sub 100, is that not rocket fuel to just send Bitcoin into the stratosphere?
Yeah, that probably sends us to like 52K, I would guess. So if this returns to the lows, I think we would see probably 52K in the first couple of weeks of February. It just absolutely rugs in the next couple of days. But the thing is about it, it's been so strong through February. Like I wouldn't be in a rush to fade this by any means yet. You would see confirmation, right? So let's look at the moving averages there. So we have 103.50 is the 200 day. It's been rejecting off that. The 100 days up at 104.29 and the 50 days at 102.82. So I think if you start to see a move below like 102.75 and it just really starts to break down here, you get a nice big thick red candle. That would probably be a pretty good risk on signal for the next couple weeks, in my view. So really waiting to see if we get that here over the next course of the couple of days, and I think that would be a good risk on signal.
All right, so the Dixie may see
but
some.
Right now, it's still in range, right? Like there's no point
right, yeah,
trying to call it top here. It's just keep an eye on this. Like you start seeing a trend above the 50 RSI mark on the weekly, we see the kind of moves that can generate for it, right? So here's the previous times it broke above the 50 RSI. June 2021, it basically held that 50 RSI all the way up to 1014. And then it stayed below it basically throughout 2023 until it caught it in August. And then we saw this huge move up. So this is very pivotal in terms of determining trend from here. Like, is this the top of this rally? I think we'll find out if it rejects from here or not. Right on the line.
Yeah, yeah. Well, it could be. I imagine for someone listening, it could be frustrating because you're wanting something definitive here. But I don't think that's the way the markets work. You got to take what they give,
patient,
yeah, and be patient, right? What Ben you said. HODL go tonight. I'm not sure I got the right name. So does happy equal soft landing? Ben, do you think that the Fed is saying that they've actually achieved their goal of hitting that soft landing?
From where they were over a year ago, I think Jerome looks like a rock star, right? Look at the speed at which he did what he did. Thankfully, he had the repo market to act as that buffer and essentially a pressure release valve for when things kind of didn't go his way or as quickly as he wanted it to. And now, the way that everything is, he's got room to do a few cuts to create a little steepness in the curve that he wants in terms of the yield curve, and really kind of set Yellen up to go ahead and distribute debt into the market. Now, what's going to happen on this next leg when the repo market, which has been really helpful to the Federal Reserve in terms of accomplishing their mission, as that runs dry, will they be able to issue kind of the debt that they've been doing without having any liquidity issues in the market? And the Fed has really said that they don't know, but they basically want to see if the market can do it. And I think this is the first major test in a while that we're going to see. And
this
so
is
that's
the Liquidity Armageddon that we referred to last week, correct?
That's correct. Yep. And because if you guys remember about a month ago, like I think Goldman was even saying it, a few other banks were saying it, in terms of anticipation of about 75 to 100 basis point cut by mid-year. That was a lot. That was too much. The market kind of calmed that down a little bit because the Fed is in a position, and they keep being explicit about it, to keep rates higher for longer. I don't know how many times we've heard that. And I don't think they've really deviated from it. And so on this one right here, I pulled up what's anticipated for March, and you can see really in the past month, only 11% probability that the rates would remain unchanged. And that has already, through the course of January, moved all the way up to 55%. Everybody was anticipating that first rate cut to happen. And because we're kind of sliced down the middle, whatever is said here this week, in terms of what's coming in March, that will reflect itself in the charts. And so that's really what we have to keep in mind. And this, going back to this soft landing or kind of hard landing, I think it's going to be a bit of turbulence. That doesn't mean we won't hit some soft landing, but that turbulence is going to be, this next phase for the Fed of, can the market actually absorb the treasuries that they really want to unload, or are they going to run into issues?
The great unknown, the void. Are they going to be selling into the void and just seeing rates just rip up on the 20 and the 30?
Yeah,
right.
I think they will a little bit. It's not going to make a new high or anything. I believe those days are behind us in terms of what we've seen. I think the high has been painted, and we're good there. But there will be some turbulence, I would have to imagine.
That's why I do think if we get that blow off top here into early February back to new highs, I think that's a gift. I think if you weren't fortunate enough to sell either before or after the ETF drop shortly after, I think this is kind of your second chance to get a bailout here if we get higher highs into early February. Well, just because that's a massive unknown, right? And anytime you take liquidity away from markets, it typically has kind of a rough ending. So you're kind of banking on an outside scenario that things just continue good forever and we continue up only forever, which with the absence of liquidity that'll be coming in March, it's a hard thing to imagine.
And think of the narrative now being blasted in mainstream media. We've just hit all-time highs. We're going to keep going higher. Everything is great. Goldilocks period, right? We are now all of a sudden starting to all get on the same side of this seesaw. And whenever things essentially all go to one side, we end up going the other way.
Take a look at the weekly chart here on S&P 500. Like, just super overextended here. Doesn't mean it's not going to go above 5,000, but I think that's a pretty good sign to sell.
Well, I actually, JJ, I think this is a good point to dive into what we were discussing a little bit on X and obviously in our internal Discord, and go a little bit into the market being short volatility and what that might actually mean. But before you answer that question, For all those who are out there, we appreciate you joining us. Go ahead, hit the like and subscribe button if you're getting something out of the show. Everyone's always asking, what can we do to help support the show? And that's the first step. It's just hit the like and subscribe. The next would be sharing the show with as many people as you know are possible. People that enjoy sophisticated analysis more than just the TA jockeys. And then for those who can, if you'd like to, use the CoinCall link that's in the description to sign up and create an account at CoinCall. And as I mentioned at the start of the show, CoinCall offers a full suite of options, futures, and spot trading for your favorite crypto assets with competitive fees and an elegant interface. I always like to note that because we always want to be looking at something pretty, and it definitely has that. And JJ is going to show that interface a little bit later on. But those are the ways in which you can support the show. It's easy, doesn't really cost you anything, and helps us get out there. If you enjoy this content, it's a good way to keep it going. All right, so JJ, I want to come back to you and ask that question. Walk us through a scenario where we talked about being the market being Vega short or volatility short, and what that could actually lead to. Because we're going in, we're talking about there being a liquidity crunch coming up. We were talking about the market potentially being on the wrong side, or maybe being short on the wrong side. Walk us through those words, what they mean, and what this audience can be looking for in terms of the way this may play out.
Yep. Let me pull up the this image here. I saw this on Twitter earlier, and it's kind of a good summation of what we were speaking about. So it shows us dealer positioning in the S&P 500. So these green bars are where you see dealers are long. So these are going to be out of the money puts anywhere below, say, 48,000 or 4,800 on the S&P 500. And they're also long at the money puts here, right? And then they're going to be short out of the money calls as well. So this is kind of creating a dynamic where if the dealers are long these put, that means that somebody's selling them to them, right? So if I'm a hedge fund, I want to capture some extra yield, I can sell out of the money puts. So long as the S&P doesn't go below 4,800, then I make money when they expire worthless, right? But at the downside of that is that it comes with all that risk if price starts to reverse. So this basically looks like people selling these puts and then buying calls out of the money, just basically banking on this extreme continuation in the S&P to continue onward. So what they're not prepared for is the scenario that we discussed last week, where DXY runs hot. We kind of get into a liquidity crunch scenario, and that price starts to slip down. All of this, like this kind of turns into a black hole where you have a whole lot of people that are not only directionally long, but they're short derivatives to get basically synthetic long exposure and be exposed to price continuing to the upside. When those calls expire, or those puts expire worthless, they capture that premium. The downside of that is, say, maybe you sell a 4,800 put expiring in March for, I don't say, $2,000 a piece, right? So basically your max loss would be 46,000. If the S&P goes to 4,100, you're sitting on $7,000 losses per. And these things multiply. So kind of the rush to hedge yourself if things start to move against you could create some pretty high amounts of volatility in legacy markets that the market's not prepared for right now. And it just seems like massive mispositioning, and the market's become so low volatility, like we see it here in the VIX. It's been a very long time since we had a substantial move up in the VIX, and people have gotten so accustomed to this low volatility environment that they're just happy to sell it for yield at any price. Basically, just regardless of where volatility levels are at, you see people willing to sell it and try to capture that yield. And it just seems like there's a massive mispositioning here in terms of people selling it. And historically, like you look at the VIX, we just get these spikes up pretty routinely, and these white people out, and we haven't seen one for a while. I'm not saying this is coming tomorrow, but it's something to keep an eye on over the next couple months, because the market is not positioned for any sort of down move in legacy markets whatsoever. And that's kind of worrisome to me, especially when you see how overextended we are on multiple time frames here. Like, look at this RSI level on the weekly chart. Last time we were this high, somewhere around November 2021, when we were last at all-time high. So it's not to say it's going to fall tomorrow, but historically we get this high. You see some mean reversion over time, and the market is not positioned for that right now.
So let me kind of try and summarize this as more, I would say, layman's terms. So we've got an extension on the S&P 500. It's been running hot for a long time, and typically just mean reversion would suggest we're going to see some kind of cool off. what a lot of market participants are doing right now is using the options market to just generate additional income. And the way that they position themselves is selling out of the money puts, and they're not necessarily fully hedged, or how they're hedged would have to accelerate if the market moves. And as you just said, the way that we look at volatility in traditional markets, the VIX has been really muted for a long period of time. So now market participants who are used to running a trade where they can capture some of that yield from selling puts, they're just expecting that to be able to run and continue to do that, juice their margins. But if that changes quickly, they're going to have to they have to hedge and cover very quickly, and that just accelerates this movement. It makes it outsized.
It's like we were talking about with the implied volatility term structure. Like, as there's more demand for volatility products, so hedging yourself with options and whatnot, that it rises very rapidly in a short amount of time. And you can see this here, like a VIX is a good way to look at it. You just see how quickly it rises sometimes. If you go back to the all-time chart, it's even more clear, right? Like, look how quickly it can go from 0 to 40, basically. And it's been a very long time since we've had any one of these meaningful wicks. And they do happen historically. So it's like and it always happens when the market's not positioned for it. Right now, VIX is at very low levels. The market's not positioned for it. That's typically the time you see one of these wicks coming up in the next few months. If the market starts to hedge and prepare for it, maybe it doesn't happen. But so long as the market remains this overbalanced to kind of the low volatility, slow grind up environment, I think the more likely that kind of scenario becomes. And it's something to be mindful of, especially in light of everything we were talking about with the kind of pending liquidity doom coming up in March and whatnot.
Let's explore that a little bit, right? If the market is positioned and they're not adequately hedged for a volatility event, what is the thinking here that they're ready for this change in liquidity in the market that essentially could happen very quickly, overnight, so to speak?
Yeah, they're not prepared for it, but that's kind of the way markets are, is people take things, you take what you see today and you project it out into the future forever. And you think things are just going to stay in this stable environment of just slow grind up forever. Maybe it does happen, right? But it's never happened before, where things just gradually move in a straight line.
And so what JJ is talking about too, if you view it from a salesman mentality instead of a trader, it starts to make a little bit more sense, where the market for really all of last year and this year have been wanting yield, right? They see what the treasuries are printing, right? They see it's over 5% on a short-term basis. They see that corporate bonds are up in 6, 7, kind of 8% for investment grade, and they want 10%. They want 12%. So the market the demand for yield is so high. I haven't seen this many yield products hit the market since a couple decades ago. But point being, I'm trying to remember the last time we've seen this demand for it. But what JJ is hitting on is that market demand. And as not a trader, right? As a salesman, you want to hit all of the sales quotas that you really have for yourself, and you want to just kind of stuff anything you can into these financial products, because that's what the market wants. It wants this yield. And so what happens is, if everybody's wanting that same thing, somewhere something's going to be offsides. So that's really what we're seeing with all the comments kind of on past week, I would say, regarding Vega.
Yep. Yeah, the people want risk-free returns, or the illusion of risk-free returns, right? As we know, there's no such things, but you can sell that to people who don't understand it fully. Hey, we have this structured product that it's had these returns over the past year, yada, yada. It looks good, but it doesn't factor in the amount of actual risk that they're taking when you sell derivative products of the VIX, right? And that's essentially what they're selling, is volatility at these levels. So like the people that they're selling these to, they don't necessarily know like these historical patterns of the VIX, how it spikes up, whatnot. They just think, oh, well, it generated 30% returns last year. I want 30% returns. And they rush into these products, and then it creates that loop where then they have to sell more.
And think of it like just a giant hot ball of money, like moving around. Like, we had it in crypto for a while. It went over into AI for a bit, and now it's hitting high yield products. And my main concern with it is that a lot of these vehicles are just locked up, right? This isn't like instant liquidity that we're kind of used to in crypto. This is more of like private vehicles. So you go ahead, you send it over, it's locked up for a certain duration. And this is not something that's going to be as easy to exit in certain circumstances. So it's one thing to know here, right? The Fed's been doing what it's wanting to do, but it has to go ahead and make an adjustment, and it hasn't announced it to the market. How will they announce it? That's what we're all kind of waiting for. And that's why we're on the balls of our feet to find out, to act accordingly and respond. And so this, I forgot where the clip was. I think it was yesterday. I think I saw a Stephen Colbert thing where they were mentioning the word Goldilocks over and over.
That's probably
kind of getting
signal.
Yeah, we're lulled into this state of like everything's good. We're going to keep marching higher, and then as soon as the Fed changes its direction, and I wouldn't say it's necessarily changing its direction. It's just it has to make a decision. It's simple as that. Repo's coming low. It needs to go ahead and make a decision on what it's going to do. Is it going to keep doing what it's doing? See if the market can absorb it and then respond accordingly? Or is it going to try to be preemptive? Well, we know the Fed doesn't like to be preemptive. So it's going to go ahead, test it out, see what happens, and then respond. And that response usually happens after we see some sort of effect on the markets. So I think Goldilocks comes to an end for a little bit.
Yeah. Like you look at how overextended the market is, and I mean, maybe they will, but the idea of the Fed easing conditions into an environment like this, like you said, typically you see them reactive rather than proactive. And like from the Fed's perspective, kind of a mini deflationary crash in the short term that brings inflation down to lower levels, resets the market a bit. That might be a welcome scenario for them, right? Like for something like the VIX to spike up, it would only take a move to say SPX 450 or so, which is still higher than we were at in October. That's not like, it's not a COVID style event, but that would cause a whole lot of damage to those structured products.
That's a really good point. This could be a welcomed event. And if we actually look at it through that lens, and we look at how all these treasuries and what they're paying in terms of yield, and you look at the 30-year and it's at 4.2%, and you look at the 3-month and it's really close to what the federal funds rate is at 5.3%, that's a dislocation. The 30-year needs to get up. So how do you do it? It needs to get above the short term. And so being able to cut rates and provide itself with a little bit of room to steepen or essentially lower the federal funds rate, they give themselves that room. Mm-hmm. They give themselves to do what Goldman wanted them to do, which is get down to 100 basis points.
Yeah. Like you look at this, they've done their job. The S&P's at all-time highs, like they've achieved high rates and all-time highs in stocks. So like the idea that they would ease from here, not to say they won't. They've done a lot of things that have confused me in the past, but I find it unlikely that they would just ease rates and send this thing up to 6,000.
And look, if this hits, this kind of gets to what Marconi mentioned earlier, which this is the opportunity before the halving, or before the real kind of meat and potatoes of the next Bitcoin bull run.
Mm-hmm.
Well, I want you guys to kind of walk through that scenario and what a trade may look like. I mean, we were talking offline, I think even on X, about, is this the trade, the best trade since 2020? Is it the trade of the year? You guys just walked through and painted the factors that could impact that. But I want you guys to kind of say, what would that actually look like? And then also, obviously, JJ, I want you to revisit the trade, the DGen trade that you've been looking at on CoinCall, so people can get a sense of what that looks like and how that's performing. Because I think we even talked about how you front run Arthur Hayes. I think Arthur Hayes on X was mentioning that his trade isn't quite working out. So why don't we start with the CoinCall one? Then I want to come back and talk to the sort of the trade of either the trade of the year, or the best trade since 2020, or something in between.
Yep. All right. So CoinCall last week. Let's see here. So I was looking at it this morning. Actually, those netted some nice profits too. What we were talking about last week is, well, what we did a couple weeks ago when we were at I think 44. We were saying the out of the money options around 40K were pretty cheap. And then we mentioned you should probably take some profit on there when we saw those large bid balls. And then we saw some a little
You know,
bit
if
of
Arthur
inversion.
Hayes was listening in, he would have taken some profit and probably been
Yeah.
okay.
That's how it
But
goes.
yeah, just Arthur, you're welcome to come on here and talk trade anytime.
So
Can we mention real quick how many times we just speculate that he must have a tap into our Discord somehow? That's come up at least a dozen times.
Yeah. I don't know. I mean, he built a whole company, he built BitMEX. He must know some good coders. I wouldn't be surprised.
So what we were saying last week, you play the bounce. I think if you did, we were recommending 40,000 to 42,000 calls. These are trading for a couple $100 each. You see that they're now 3,700, 2,875, and I think this is another scenario. You see profit, take profit. Don't be greedy and try hold these till expiration. You got a nice like 2 to 4x on these. So take some profit here if you were long that trade last week. And then the way we hedged that was we took deep out of the money put options for the end of February. And I think you still hold those just because they're so cheap at this level, right? Like I think these were trading for maybe like 300 at the time, the 36,000 puts. Now they're at 132. So you lost a couple $100 on paper there. The gains on the calls overweighed that. So I think you take profits on the calls, hold these for now, and just wait to another opportunity to get long back near 42,000 or so in the next couple days. So keep an eye on that. But if you see profit there, take it. These expire in a little over a week. So I wouldn't want to be caught holding these if we do get a reversal. If FOMC is more bearish than expected. You can't be greedy with these things. They'll find a way to bleed you out. So
don't be greedy.
Profit, take it. Wait for another opportunity when these premiums drop down a bit in the future. And if it runs without you, maybe buy some spot to hedge yourself on the long side. But I still think holding like you could even go out to March and the put premiums on those have just been dropping. So I think the risk reward to buy anywhere from like 38,000 and below, I still think this is a good and valid trade into March, even if we do get that upside move. Like you're not going to lose too much money on this. Basically, you're just risking some of those gains you made on the early February calls if you took that trade. And I think that's a good way to parlay it, get yourself an extra hedge here if you have some long exposure. I still think these are undervalued potential to the move Bitcoin could make in the coming months.
Okay. Look at that beautiful, elegant interface for anybody looking to trade on CoinCall. And I know it's open for our non-US citizens, but it's definitely a good option if you're looking for a good place to trade. Okay, let's now get into the trade of the year, the best trade since 2020, perhaps the best trade of your lifetime if you're new to crypto. So let's walk through this scenario. So we painted the picture about Liquidity Armageddon. JJ, we added this week about the market being offsides, right? That there's short implied volatility, which could then just lead to a really large, massive dislocation. Imagine that's going to have spillover into the crypto markets. And I'm curious if you guys think that would be, crypto would be the canary in the coal mine, or it'd be an afterthought and just be impacted by it. But as that starts to walk us through what that looks like as that plays out, and where someone, if that looks like the fattest pitch you've seen in a long time, what is it that you're looking for and how are you swinging?
If we do see that, my kind of mental mapping of it would be something like what we saw pre-COVID. So large run up December to February, about the second week of February, topped at the upper end of the weekly Bollinger Band. So I think if we see a move above 50K, that would basically be similar here. So next 2 weeks, if we make that move up, that would look very similar to this. And that would likely be followed if we do get some kind of liquidity crisis by a retest of the lower end of the weekly Bollinger Band. So I see anything between the 200-day moving average at that time to the lower end of the weekly Bollinger Band as you're basically, this is the level you go all in at. So anywhere from 33 to 24,000 right now. If we get that overextension up, liquidity goes missing for a couple months, I think you could see that wick back down, clear out all the long liquidity that's plaqued up since October. And this would really be your generational buy zone if we're lucky to get it.
So JJ, are you just looking at this chart and using it as your North Star on whether or not that, the liquidity Armageddon played out? Or are you looking at the rest of the macro markets to see how the options played out, the Vega short played out?
I think it would all sync up. So I think we would probably see it in Bitcoin first. Historically, we do.
So you think Bitcoin is the canary? It starts to show its cards before the rest of the market.
Yeah, definitely. Like we already saw it. So Bitcoin started its move up October 16th, and it kind of started going parabolic then. It took the S&P a while to catch up. So if we look at the S&P, it wasn't until the end of October, early November, that it really started its move up. And now it's reaching over extension here. And Bitcoin's already broke down a bit from the highs it set in early January. The S&P hasn't. So I think we see Bitcoin lead this relationship more often than not. And I would expect the same here. Like, I think Bitcoin would break down before the S&P, and that would be your signal that liquidity is getting tight. If you saw Bitcoin start to break below those lows we set last week, that's probably a good signal that something not so good is coming.
All right. And how do you think the most sophisticated traders are going to play this? Are they just going to buy spot? Are they going to be going in on perpetuals, or are they even looking at options? Maybe a mix?
It's hard to say. We'd have to see what it looks like when we actually get to that level. I think you'll definitely, like, we already saw demand for Bitcoin in this range here, which is around 36,000 and below. And I think that would continue. We would probably see a lot of liquidations, obviously, because there's been this whole leg up that was never kind of retraced. So who knows how much liquidity is hiding at these, sub 35K levels that hasn't been tapped yet. So we could see kind of a large liquidation run. And I think on the other side of those forced selling would be spot buyers. I think you just buy spot, wait a couple months till it gains some momentum before you start longing derivatives.
Okay. As I'm asking that question, I'm looking at Mara Wolf, MicroStrategy, and Coin, and thinking to myself, would you not just buy some derivative Bitcoin equity stocks, high beta? Maybe you do 90% into the sweet corn, and then you got 10% sitting in the beta.
Yeah, I think there's definitely going to be a beta play to be had. It depends on how deep these goes, how deep these equity stocks go, and how bad the correction is on equity. Like, they are correlated to Bitcoin, but they're also correlated to equity. So there would need to be a period of stabilization after the crash to really feel confident jumping in anything beta or derivative wise. Okay.
All right. So you have the way JJ thinks this is going to play out, or could play out, right? We're not,
it's a possibility.
We don't have a crystal ball
like,
here, right?
I'm not saying this is, I would probably put it at like 30% possibility that we wick above 50K and return to sub 30K.
Sure.
But it's far from a 0% chance. So it's worth having a plan for in the event that we do see something like that.
This is where patience plays out. Ben, I want to bring you up here, put the spotlight on you. Is this how you think it plays out? And what are you looking for? And then after that, how do you think the sophisticated trader is going to play this?
Well, since I don't like the spotlight, I'm about to shine it back on JJ. Because I have a question, really, because this was a discussion. We saw one of those yield products, and I guess they're going to mint a 30% return. Since I guess they rolled it out. I don't remember what the time frame was on that, but they were selling puts, taking the premium, using that to buy calls, and then holding spot in order to meet that call if the put, if they need to sell the spot to meet the demand on that put. But do you see that as an opportunity for holding spot positions in such event and ride that through the upside by using the premium on puts to collect a little bit more on the upside?
Not at this level, because the implied volatility levels are so low that that's, if this implied volatility level was above 70 and puts are trading at extreme premiums.
Yeah, let me back up on the event that we're discussing here, where there is a sell-off, there is some fear, and the market gets into that uncertain state of mind, which now it's time to go ahead and buy some insurance premium.
Oh yeah. Yeah, that would definitely, you'd get some juicy put yields if we break down below 30,000. That would be similar to FTX when people start betting it's going to zero, at the in November 2022, 10K puts like a month out were trading for a few thousand just because there was one FOMO shorting and two, a need for protection. So you just saw the IV on out of the money puts go through the roof basically. So if we do reach that scenario, you don't want to sell at the crescendo because obviously things could go to zero and you'd be liable for a whole lot of losses. But if you see some stabilization, Bitcoin starts to trend back above 30,000, those out of the money put premiums would probably still stay pretty high, and you could probably sell them for some nice yield. holding spot and maybe hedging with derivatives to protect your downside there.
So would you, in that sort of scenario, if Bitcoin is within the low 30,000s, it's calmed down just a little bit to give you enough confidence to go ahead and start putting a position on, are you looking at short dated puts to sell and then trying to capture with that premium some of the longer term call options on the upside, kind of further out the money?
I think the way I would probably structure that would be to sell put spreads. So you buy like 1 month out, sell 3 month out or so. Roughly the same strike, like maybe buy a $25,000 put that expires in a month, sell one $20,000 put that expires in 3 months, take that premium, and then you buy some $50,000 calls that expire at the end of the year, something like that, where you could really capture the upside, especially if it is paired with an unlocking of liquidity by the Fed. And we kind of know that playbook, how Bitcoin reacts. It just takes the market a while to get the signal. Like, let's look at March 2020, right? This was basically the day the Fed said we're just going to print more money than you can count. And look how long it took for Bitcoin to really accelerate. So this whole range here, this whole compression, it'll probably happen again.
Was very low right then as well.
Yep.
I remember
you could just stock up on 50,000 plus calls that expire in either December or early 2025. And I think you would get some juicy upside there if we're lucky enough to get that kind of wipeout.
That's when Suzu was starting to seed the market for Gamma that exploded at the end of 2020, early 2021. But yeah, so getting back to kind of what you mentioned with the Fed, if we have such a scenario that begins to play out, what I'm really interested in is, well, we mentioned before, we're going to have a little bit of a liquidity shortfall. If there's a liquidity shortfall, it's going to really emerge on US treasuries, which means if there's less demand for these treasuries, yields are going to start running up higher. So the narrative that I almost can hopefully happens, because if we see this starting to hit the headlines and your timeline, like this is your moment, this is your signal, which is the market doesn't want US debt. There's too much debt. Oh my God, they're going to default. We're going to have a lower rating. It's going to go from this pristine collateral and get down a rank from Moody's or the S&P. Like that right there is your signal that the market is very fearful, that yields are starting to creep up higher, and we have a bit of fiscally mismanagement taking place. That is the perfect ground, fertile ground for a Bitcoin narrative to show up. And that's what happened in 2020. And that is what I could see happening here in terms of narrative just catching fire. Now we see it show up in the Larry Fink, marketing machine, getting printed out every day at the market open on CNBC. And it's essentially a dream scenario if it hits, and pair it up with the halving. I mean, that's kind of why offline last week we were just joking, like this could be the trade of the cycle if it hits. So just planning for, even if it's a 10 to 20% probability that this event happens, this is something that you do take the time to think about, because that's the type of payoff that could take place if it hits. And you don't want to be reading those headlines and really rethinking yourself like, oh man, is this debt really going to cost? Like, no, it's not. I'm sorry. Like, don't buy into that, right? This is just because it's a reaction and a lack of knowledge on what's driving these yields higher. Like, and now we know. We had this discussion. We can think about it when it happens and react accordingly because we took the time to prepare, right? And so sometimes a lot of this brainstorming session and this banter that goes back and forth, it's just planning for these 10, 20, 30% probability events so that when they hit, you're not sitting there like wondering, oh, man, let me paint this line here, paint that line there, because it's too late. The bias is there and you're not going to make the decision you likely want to make. And so here we can anticipate something that's coming, right? They're going to have this decision to make on the liquidity front. How severe does it get? We don't know. But we've kind of outlined a few situations that can happen, maybe some some speak that might happen from the ivory towers, and we can go ahead, see what mainstream media might even say, and then act accordingly. And what JJ just outlined when it comes to the options trade, like that's something that you can do and really reduce some of your risk exposure, but then take advantage of the upside and basically just be collecting premiums and doing the opposite essentially of what everybody else has been doing for the last year, because volatility regime it will change at some point, and then you'd be able to collect on it.
Exactly. The worst thing that could happen to you would be to not think about this scenario and then price crashes here and you have to panic sell. The same way people panic sold during COVID, right? You want to learn to think ahead and see those moments as opportunities rather than, oh, I have to sell everything today because it's going to go to zero. Like, just recognize it for what it is. There's those wipeouts periodically.
Can we take a moment and just talk about like a put? Like a lot of people understand it as downside exposure. And they always say you're betting to the downside. But if you hold, let's say, one Bitcoin in your account and you sell a put contract, right? You're giving somebody the right to buy that Bitcoin at a certain price. So if they go ahead and can exercise it, and they don't really exercise these options, it's all based upon essentially the P&L difference. But can you walk them through what that would look like and what happens? That way they kind of understand if they actually were to go ahead and sell a put against their spot Bitcoin to collect some premium. And I know you outlined one where you go ahead and you hedge yourself by doing a spread, but if you just outright sell one put contract, kind of lay that out for them.
Mm-hmm. So you have one Bitcoin and you sell one put.
Yeah.
So basically then if you sold, let's just look at this one, for example. So it's a March 28th, 40,000 put contract. So right now it's trading at roughly 14,840, or I'm sorry, 1,485. So if this put expires worthless, if March comes and passes and Bitcoin's above 40,000, you collect all of this premium, right? Now, every move to the downside it makes, you're basically liable for $1 of losses below 40,000. So your break-even price would be 40,000 minus this premium. So that gives you a break-even price of roughly 38,600. That means for every dollar below 38,600, Bitcoin's price is at expiration, you owe $1. So if this were to go to 20,000, you would lose over $18,000, right? It's not really a great risk reward in that scenario because your downside is not unlimited, but it's basically you're risking $38,000 to collect $1,400. So the way you would hedge that would be to buy either a longer dated or a shorter dated put that capture losses. Say you could buy one right here for 475, the 35,000 put, and this would cap your losses at roughly 34,000 and change. Like that would be your stop loss there. So you're only losing kind of the spread between these two. Does that make sense?
Mm-hmm. And then if you have, say, one spot Bitcoin, you went ahead and placed a stop loss around that price region you mentioned. I think you said, what was it, 38,600 or something. And so if price continues to decline and you went ahead and entered that on your spot, where do you sit on that P&L?
So then you would take losses on the spot as well as the put? Is that what you're asking? Like you sell this put, it moves to 38,000. You have the put losses, which would be multiplying, and then you're also losing on the spot that you're holding?
Well, I was really just trying to outline a situation where your downside is minimized because you went ahead and sold that Bitcoin at that price. If price continues to decline, like you can meet the call on that put.
That would be if you bought the put. Is that what you're asking? So if you have
if you sold the put to somebody else and they went ahead at, say, exercise at a lower price and it closes at, say, to a...
Right. So if they exercise it, you're long from 40,000. So if you sell this put, they exercise it, you're now long Bitcoin from 40,000. And you could sell your spot Bitcoin to cover that.
Correct.
So basically hold your place here.
So
you hold one Bitcoin, they exercise this, you sell the Bitcoin that you hold, And now you have exposure to Bitcoin at 40,000 if this were exercised.
Ben, I think I'm just trying to make sure I understand what you're getting at here. You're thinking of someone who's trying to, they got exposure to the market, they have a Bitcoin, maybe they're not trading on a frequent basis, but they're looking to to not necessarily get out of the market, so they want to buy some insurance. Is that what you're
So
thinking?
this situation is where you want to go ahead and take advantage of upside.
Mm-hmm.
And so you hold spot, but you're worried because of everything taking place around you that maybe it goes down to 20,000 El Capo's right.
Mm-hmm.
Or 12,000, I think was his price target. And you went ahead and you sold a put contract. You know, this is probably new territory. Many tend to be very worried about selling a put contract because you could be on the hook for, you know, tens of thousands of dollars. So how do you minimize that risk exposure on just selling one put contract as an example, right? You just mentioned how much premium is attached to it. So if it goes ahead and it expires worthless, you went ahead and you collected a premium that you can go ahead and place in the market on an upside bet. Okay. This is just a very simplified way of kind of viewing how to earn premium, right, on and hedge it against what you have for your spot, and then go ahead and start looking at trying to use that premium to get upside. So price comes down, volatility starts to expand and explode. You collect some of that premium. You use that premium to then go ahead and buy the upside. Right? If we're thinking that we're getting into the meat potatoes of the Bitcoin bull market in late 2024, you're collecting premium on a sell event to go ahead and capture that upside at a later time frame. Mm-hmm. And so that's trying to simplify a little bit of what JJ's getting into, where he's trying to talk about, you know, buying, I forget the method you were talking about, but you're doing put spreads, but it's really like a calendar. So he wants to do long dated, short dated, this and that. And it starts to get a little bit complicated for people to understand why.
It's a lot of recommends pieces.
It is a lot of moving pieces, but really what he's doing is he's trying to collect premium and he's trying to reduce his downside. Mm-hmm. And so as you get into these more sophisticated strategies where you're looking at different dates to either collect premium or buy protection against some other option that you bought or sold, like that's what he's doing. So it was trying to like simplify, which is never easy to do in options.
Well, yeah, I mean, a different way I may say, and you guys can chime in here. Let's say we're sitting here, it's now at 50,000, right? And you've got your Bitcoin, and you can buy a put, right, at 50K, which is going to be expensive at that moment. But you have this event, and the market goes down, right? You're able to then sell that put. You can exchange the Bitcoin at 50K if you want, and then you can be buying lower, right?
Yep. It holds your place. Like that's the way you should look at these too, is that it's not necessarily you're betting against the market. It's more like you're protecting yourself. So you hold one Bitcoin, you buy this 40,000 put. So 40,000 minus 1,400, this puts effectively your stop loss at 38,600, right? So you know, okay, all losses, any move Bitcoin makes below 38,600, I'm covered on a one-to-one basis if you hold one Bitcoin and one put. So it's just protecting you. And then you get that downside move. You can kind of see the market more clearly because you're offsetting your losses with this position. And then you can close it out. And now essentially you've added more money on a down move that you can then use to bet on the upside when these IVs drop off if we do get a downside move. So all of a sudden the call premiums, if you go further out, like you start looking at June and September, those $50,000 calls that are pretty expensive now, if we got a move to say 32,000 would be a lot cheaper at that point, more than likely. And then you could buy them because you had this position that was gaining you money as the price went down. So it's just a way of like kind of playing for every scenario. That's the beauty of options, is like very rarely am I in any single directional position where I'm like, okay, price has to go up today. It's more just like looking at these spreads and figuring out what makes sense in that time period. Like last week, that was a good example of it, right? Is that we were long the out of the money February puts deep in February because they were cheap, and they still are cheap. They've only lost probably $100 or so on this move up. So you don't lose too much. And then we're also long calls, shorter dated ones that multiplied by 2 to 4x. So now you just rebalance that. It's like, okay, I got a nice 4x on this gain. I'm going to take profit out and wait for the next move to kind of reveal itself here. And you still have that protection through February, and it doesn't cost you anything because you had this upside move.
And to get back to kind of your earlier example too, Marconi, just you said the $50,000 example. You know, if I sold you that put and I went ahead and placed that stop at 50 and it goes down to 30, you know, I can go ahead and we can settle the difference. So I owe you 20,000, but Bitcoin's now at 30,000. So I'll go ahead and purchase that back on spot and I still hold 1 Bitcoin.
Mm-hmm.
But
Yeah.
I collected that premium.
Absolutely. No, it's thinking a little bit differently, I think, than the typical mindset, which is basically find a token and hold it. This is definitely, as we say, this is a show for the sophisticated. Okay, well, I think with this mini tutorial, for those who are interested in getting deeper into options, JJ does have a course right here. It's a playlist that's on the Exchanging Good channel. Go check that out. He's constantly adding new content to that. JJ, do you have an idea of when your next video is coming out?
It should be within the next week. So we just got a sample back from the studio that's producing it. So should be coming up here shortly. Stay tuned.
Exciting times. You're not going to want to miss that. So definitely hit the like and subscribe button. All the buttons you can right there. Just hit them all at once. And make sure to be able to come back for when that comes out. But I think with that, we're going to wrap up today's show. I'm looking at the market as we wrap up. Bitcoin sitting at 43,500, Ethereum at 2,300. So definitely flowing into the action, price action that we talked about earlier in the show. I think if you got questions, I see someone's asking about a scenario in the chat coming from Huddle tonight. Is ETH going to go lower than 0.048? And what happens if Bitcoin hits above 50K? Where does Ethereum go? I think those are questions we're going to come back to on Thursday. So be sure to come back to the show. We can answer some of that because it's all the time we have. This is all the time we have for today. And additionally, I've been trying to get JJ to talk a little bit about options for US-based people that maybe can't get into CoinCall. So we're going to try and bring that on the show as well. So you have some options for those who are in the great United States of America. All right, guys, that's going to do it for today. I want to thank JJ. I want to thank Ben for showing up, dropping the alpha. I want to thank all of you for joining us on this journey. And with that, I'm going to wrap up. This is Marconi White saying keep some dry powder, stay safe, and until next time.